name is Lawrence Laddie, also known as Mr. International. And I am here located here in the New York City area, the Bronx specifically. I have 2 properties here in the Bronx. I'm going to scale my business this year here. So I am looking in the Piedmont Triad area in Greensboro, Winston-Salem, and High Point. Also looking at Huntsville, Alabama, and Norfolk, Virginia. So without further ado, I have to bring on a friend of mine. We got to know each other. We got together in December, right before Christmas, down in Greensboro. Then we even got to know each other more when we went to the extraction, right? Presented by Myers Methods, which I am a proud member of. And we was in St. Lucia. So 5 days, right, Kofi? 5 days?
Oh yeah, it was an absolutely awesome time.
And me and Kofi got a chance to sit down and talk and get to know each other better. And Kofi's a wealth of knowledge, positive guy all the time, right? Never Debbie Downer, always positive and upbeat. And he has a different spin on creating wealth, right? By using insurance as a tool to help you create your financial wealth. So without any further ado, Kofi, welcome to Financial Independence for Small Multifamily Investing. Thank you for coming, taking the time. I appreciate you, and the floor is yours.
Awesome. I really appreciate that introduction. So very glad to come through and educate you guys on a couple of different, nuanced ways to build wealth. As a wealth advisor, I do believe in, diversification. So when building wealth, having different assets can really allow someone to maximize their overall goals. So I want to present this slideshow just to go through a couple points. Really want to be, a conversation, have you guys asking questions while I present different things. This is overall just like a really, learning opportunity for you guys to learn more about something and see if it could, possibly benefit you on your journey. So let me go through and pop this up really quick here. All right. So today, again, we're going to be talking about, how to use insurance for creating wealth as a financial tool. So how to bank on yourself. So for a lot of the people that I'm generally working with, a lot of them have, pretty similar values. A lot of them are business owners and real estate investors, and they have goals of creating perpetual wealth. Along with those goals of creating perpetual wealth, oftentimes I find that their values are, of legacy. That's like passing on money and knowledge, their family mission and values and traditions. Leadership, having leadership in their community, helping people learn, grow, serve, and nurture the people around them more. Creating a strong financial foundation. That's like having, savings and protection and positive money habits for not just themselves, but also the people around them. And also, creating family lending. So that may be borrowing and replenishing funds and finding ways and opportunities to invest more into their own human capital and the human capital of those around them. So really centering in on this goal of perpetual wealth, can seem relatively simple, but we know it's not easy. We know that there can be sometimes some roadblocks that can keep us from achieving this goal. So what are some of those roadblocks? It can be the conventional way of thinking. We know that, the same problems that we face today aren't going to be solved the problem or the way of thinking that got us there. So sometimes it can take understanding or looking at a problem a little bit differently in order to find a good solution. So when you think about insurance, there are a lot of conventional thoughts that people generally have towards insurance. One major thought can be like cost versus value. So what I find when it comes to cost versus value is that if someone is looking at the cost of something, they're generally thinking more short term. They aren't really thinking, extremely long term. And I'll take the example of food, right? We can look at food and say, okay, like if you don't want to spend a bunch of money on food, you're not going to go organic, you're not going to go, farm raised, you're going to get the cheapest thing out there, the lowest cost. But the long-term repercussions of that can end up in higher health charters down the road, if you have any types of problems from eating cheaper food. So that's like more of a cost-based decision. It's relatively short term, but when we make value-based decisions, they're going to be long-term. You may spend a little bit more on your food. You may be spending a little bit more in other areas of life because you have a value on your health. And I know that when I went out and, maybe spent a little bit more on something that I truly valued, generally that actually cost me less long term. So whenever I'm going to make any decision, whether it's just going out again, like buying food or buying a new car, whatever it is, or especially looking at a financial investment, I want to be a value-based thinker. I want to think long term and say, okay, what is the actual long-term value, and then will I get a rate of return that outweighs the short-term cost? The second point is that, life insurance is just for when you die. Well, that's generally, again, more of a conventional thought. I think of it as like, real estate is just for a place to have shelter. Well, the main purpose of real estate is a house to live in, but we know that there are many other purposes that real estate can serve. It can be a great wealth building tool. So looking at something, in a slightly different way allows us to see the benefits of it that can be more than just the face value. The next piece, and we'll talk about this more, is buying term and investing the difference. With all these different strategies that, I'll talk about, and really with any type of financial investment, there is no one shoe fits all. I don't believe that everyone should try and look at, infinite banking or, whole life insurance policies, and everyone should look at term. It really depends on what your specific goals are, and finding the right fit for what you're looking to achieve is extremely important whenever you're making any type of decision. Again, there's no one shoe fits all in any situation. So let's talk about banks, because this will be a great premise for some of the things that we'll be discussing a little bit further on. So why do most people use banks? Most people utilize banks because that's what everyone else does. It's kind of the group effect. We think about it like, okay, everyone else puts money into a savings account. I should put money into a savings account because this is just, what everyone else does. It's kind of a group psychological effect. When everyone is doing something, it just seems like a great idea. Well, I'm sure a lot of people here have strayed away from the crowd on some decisions and found there was value in looking at other opportunities. Again, it's all based on your own personal goals. But another reason that we utilize banks is because they're safe and low risk. And when I say low risk, I want to specify market risk. We know that when we put our money into a bank, especially, for example, if the volatility we're facing in the market, we're not going to see our balance decrease. So you're not going to experience any type of market volatility. We know it doesn't have that risk, but it's not necessarily risk-free. Some of the risk that bank accounts do have is they have purchasing power risk. Now, what is purchasing power risk? Purchasing power risk are when your dollars cannot purchase as much down the road. And I'm sure you guys see that with your gas prices and food. Purchasing power risk is created from inflation. So we know inflation is extremely high right now at around 8.5%. On average, it runs about 3%, but having your money essentially just stored in a banking account over the long term, you're going to lose the ability to purchase things down the road. But another reason why we also place money in bank accounts is also because, again, they're safe and they're backed by a AAA rated agency. I'm sure some of you guys have seen on your bank accounts, you have FDIC insurance. That means that up to $250,000 in that bank account, you don't have to worry about if that bank were to fail. You know that up to $250,000 of your dollars is going to be safe and insured. Anything above and beyond that, it's kind of good luck, but at least up to $250,000 is going to be safe and insured. A couple other reasons why people generally use bank accounts is because they give you interest, even though that interest doesn't necessarily compete with inflation or taxes, but they're still giving you, a little bit of money for, leaving your money there. Additionally, forming relationships with banks, that's another important piece. especially if you are in the space of real estate investing or a business owner. Having the ability to have a great relationship with a bank in order to have access to financing, it may be more prime rates than your average retail consumer, is going to be a great, benefit. And then convenience. It's super easy to walk into your bank, talk to the teller, get updates on your accounts. So those are some of the main reasons why we utilize, banks. But the reality is that we don't know, the full truth, because banks are making money off of us, whether or not we have good credit or we have bad credit. So let's talk about some of the ways that banks make money. They're making money regardless. You know that when you go to the Capital One Center to see a game, all the different properties they have, like they're some of the biggest players when it comes to institutional investors. They make money off of physical assets like buildings, land, furniture, cars. When you go get a loan on your car, they're going to own that car until you actually pay off that loan. And if you don't, bank takes it back. They also make investments. A lot of banks will invest in different asset investment securities. I'm sure you guys have heard of, or may be familiar with, like collateralized mortgage obligations. Those were investment securities that are actually very high risk that led to the market crashes in 2008. So banks will leverage a lot of their money in different investments also to have a return. The main way that banks do make money is actually through loans, mortgages, and credit cards. So the difference between the lending interest rate and your savings rate is going to be pocketed by the bank for their expenses. Now, average savings rate on a bank is about 0.06%. So when you get a loan on your credit card for 16, 20%, they're making that difference. And that's a great deal for them, but not as much for us. Another big thing there is that banks, again, are able to leverage a lot of their money. So there's this thing called a multiplier that for these large banks allows them to create 9 times or more for every dollar they have deposited. So banks love deposits. They'll a lot of times give you the bonuses. Again, they're giving you, savings and interest for making those deposits. But when you put $1,000 in your bank account, they're able to create $9,000 worth of loans from that money in the form of credit cards, mortgages, and auto loans, and so on and so forth. So this is how they've become such big players. And this is why, a lot of these major banks have been around since the 1800s, and they're able to get through a lot of different, terrible economic environments like world wars and, market crashes and things like that. These guys are just going to be major players. So, what are some options that we have to, maybe learn from what these banks are doing and start banking on ourselves? So when it comes to, banking on yourself, there are a couple of different benefits. I'm going to get more into, how it exactly works. But again, and this isn't a strategy that's for everybody. Again, very important to make sure that you know what your goals are and see if this could be a great fit. When you bank on yourself, you're creating an asset instead of having a liability. Now, for a lot of people that are, I'm generally having conversations with, they're very wealth-minded. So they want to have ownership and they want to create assets. They want to have less bills and they want to have more things of which they're putting their money into, and they're going to get something back, because I don't know many people that are wealthy that don't own things. Ownership, creates wealth. Another piece is getting a better return on your safe money in your reserves. We talked about how national average is 0.06% on most savings accounts. So you're not really getting a great rate of return, on those safe dollars. It also allows you the opportunity to leverage deals for other business opportunities. So if you are trying to, whether, purchase a piece of real estate or take out a loan for your business, you're able to maximize more leverage for those deals and different opportunities. And also creates more tax efficiency. When you do have a bank account, you're getting dividends on those bank accounts, you're actually paying tax every single year. And for someone that can be in the upwards tax brackets, of, making more than 500,000, they can be taxed at a rate at 35, 40, 45% when you add in state income, social security taxes. So that can be a huge piece, there as well. It also creates security by having a non-market correlated asset. So when you are banking on yourself, you're essentially investing in that company, that insurance company. And by doing that, your dollars are not tied to the market. So in the same way that you have a bank account that is not going to be affected by market volatility, the same thing happens, in those policies as well. You have access to loans without credit checks. So you don't have to worry about going through and getting a credit check every time you get a loan. The money is not accessible to creditors as well. So if you have a situation where you have a creditor or you owe money, they can actually go into your savings accounts and take money from your savings account if you owe. Within banking yourself and how that strategy works, they don't have access to any of the cash value in your policy. So it really gives you a lot of safety there as well. Dividends that are in addition to the policies that you would have with this strategy can also create an income stream, provides more liquidity, can aid in creating generational wealth. And another big thing is privacy. Life insurance holdings don't show up on credit reports or title searches. So if someone wants to understand what assets you have, they're not going to see the cash value that you own. Additionally, policy loans don't show up on credit reports. So if you take out a policy loan, it can really come in handy if you want to apply for financing later, because that's not going to show up on your overall credit report. So it can really provide a lot of benefits for the savvy, conscious investor. So let's talk about how it actually works. So think about a house. Many people purchase houses because of the potential to build up equity. So a big reason why people, and again, purchasing a house isn't right for everybody, but a big reason why people do purchase houses is because they want to know that their payments are going to be going towards a deferred savings that they're later able to access, whether they need a home equity line of credit, or when they actually go through and sell that house, they're going to be getting something for their dollars that they're putting in. Cash value is an asset that goes in your balance sheet. So just like any other asset, this is going to be something that does contribute to your overall growth of net worth as well. And you can access that cash value in multiple ways. We're going to talk more about that, but you can take distributions from a policy, you can take policy loans, or you can use your policy as collateral through a bank to get a loan at a preferred rate. And the policies are going to be similar to secured debt. However, that company is indebted to you. So when you have that policy, essentially what it's describing is that when you pay your premiums, that insurance company is saying that, hey, we are indebted to you a death benefit and a guaranteed cash value by you continuing to pay your premiums. And when you're employing an infinite banking strategy, it's actually not utilizing that main reason why most people get life insurance. It's not for a death benefit. They're actually overfunding the policy specifically for a cash value. And so how that works is similar to a mortgage. You can imagine your normal 30-year mortgage, you're going to have, the lowest payments overall, and it's going to take you a while to build up equity within that mortgage. But then after 30 years, you've paid it off. Now, if you wanted to do a 15-year mortgage, you're going to pay that mortgage off in a shorter amount of time. You're going to build up equity a bit faster, but also your mortgage payments are going to be higher as well. So with an overfunded policy, you're essentially condensing down the time that it would take to generally pay off that policy, allowing you to have access to a policy that is going to continue to grow without you actually making payments into it, and also access the cash value. So again, think of a mortgage and you just condensing that time period down to pay it off faster. These policies have a guaranteed dividend, a guaranteed cash value, and also a guaranteed death benefit. That's something that can be very important for someone that, wants to have some safety, especially in volatile markets. And the policy guarantees and returns are going to be backed by that insurance company in the portfolio. So this is, one piece that is very important to know, because just like purchasing a piece of real estate, not every insurance company is the same. I'm not going to say every single real estate property is the same. Like, that's why people go through underwriting and understand what is the cap rate. If there's a lot of vacancy, what is the neighborhood like? You want to evaluate all these different things as you would for real estate property to make sure that this is going to be a good place to store your money. So when I'm thinking about, infinite banking, I'm saying, okay, let me evaluate that company. How is that company actually performing? Is it a good company that I should be investing into? But again, yeah, it's never that simple. So when it comes to potentially looking at a strategy like this, it is life insurance. Remember that piece. So you do have to qualify for a policy by passing a health exam. So it is going to be contingent upon your health and also age as well. So another reason why it may not be the best strategy for everyone, because if you are for any reason uninsurable, that can have a big impact on whether or not you can actually utilize a strategy like this. The second, important thing is to work with a AAA and mutual rated mutual company. The reason why those 2 points are important is because thinking back to how bank accounts are insured by the FDIC, they're insured by the US government, which is a AAA rated agency. So if you want to assure that your policy and your capital is going to be safe, it would make sense to also, be with a company that has a high financial strength rating that's going to be AAA rated, because your policy and your funds are only as safe as that company is. The second piece is looking at a mutual company. So there are generally 2 different types of insurance companies. There are stock-owned companies, and then there are mutual companies. Stock-owned companies are going to trade on the stock market. They're going to be publicly owned, and they're going to have stockholders. Mutual companies are going to be privately owned. They're not going to trade on the market, and they're owned by their policyholders. You can think of like a credit union versus a public bank. So these stock-owned companies, when they make decisions or they pay dividends, they're making decisions based on what's at the benefit for their stockholders, not their policyholders. And additionally, when they pay dividends, that goes to the stockholders first, not the policyholders. So that's not really in your best interest if you're looking to, whether it be get life insurance or, employ a strategy like this. With mutual companies, they're going to make decisions based on the benefit of their policyholders, and they're also going to pay dividends only to their policyholders. So it's going to be a much higher value for someone that is looking for something like this. Again, another big piece is also working with a company with a strong dividend history. A lot of these, larger insurance companies, these larger players, have a dividend history of paying every single year for the last 120, 110, 150 years. So it's extremely important to go for a company that has a strong dividend history, because that'll make sure that as your policy accumulates, you're going to continue to have maximum growth. And I'm the type of person that I like getting the biggest bang for my buck. So I'd much rather put $1 in and get 5 back than $1 and only get 2 back. Another piece is also making sure your policy is properly structured. So because this is a strategy that's not focused on that death benefit, it is important to make sure that a policy is properly structured to focus on your cash value. So with that, you want to make sure it has things called additional purchase benefits, which is essentially cash going into just your cash value, not buying more death benefit. So really making sure that you are getting something that is a right fit for what you need is extremely important. Another piece is it's a mid to long-term strategy. This isn't something that, you put your money in and you get your money out 1 or 2 years later. I wouldn't recommend you purchase a house, try to put a bunch of money towards your mortgage, and then try to take out a home equity loan a year or two later. That just wouldn't be a great financial decision. That's what savings accounts are for, high liquidity. So this is for someone that, has the foresight, that can stay committed to the actual, mid to long-term strategy that they're employing. And the, sixth point, and probably the most important, is working with an advisor, not an agent. So there are a lot of people in the industry that aren't focused on recommending and making sure that the people that they're working with are getting what's in their best interests. They're usually more concerned with just making a commission, or they're usually more concerned with really just putting money back in their pocket. So it's very important you're not working with someone that's an agent that's just gonna try and sell you whatever they have. You're working with someone that's an advisor that will actually give you advice, and especially to make sure if this is even right for you. Actually going through and understanding what your goals are, what your current financial situation is like, to help you make the decision about what is really going to be best for you at the end of the day. So there are a couple, more important considerations. So with a strategy like this, it's pretty common and recommended practice for someone to put at least 5 to 10% of their regular income into a whole life policy. So just as you would with buying a house, it's very important that you can make that commitment. If you want to purchase a house and you don't think that you can pay the mortgage after 6-7 years, maybe because your income is, a little variable, not going to be the best decision to make. So it's very important you can actually make that commitment. Another piece is that if that policy were to lapse due to unpaid premiums or an outstanding loan, it could potentially cause a very large tax burden. So very important to make sure that you are very well informed, and again, working with someone that can help you utilize this strategy, not just in that moment, but also through the years while you have a policy. So for example, say you have a policy and you have $500,000 of cash value in there, and you have a $300,000 cost basis. If that policy lapses, you would be responsible for $200,000 of income coming in. So not a great situation to be in, especially if you're in a very high tax bracket. And I always want to reiterate, just like any other investment, this is not a strategy that is for everybody. There's no one shoe fits all. It's very important to understand what your goals are and what you're trying to achieve and make sure it is the right fit. And it's really not for people that, don't have financial conviction and aren't able to think clearly and really see the process through into the future. So very important to have, think long-term when you're employing something like this, to make sure it's going to be a great strategy for you, overall. So there's a lot of people out there, that talk about, or they question, critique high cash value life insurance. But, the reality is our bedrock financial institutions, contradict a lot of what they're saying by investing billions of dollars into life insurance. So banks store and grow a significant portion of their capital using permanent life insurance. A BOLI is a life insurance policy purchased by a bank on their executives in order to offset, employee benefits, things like healthcare, 401k programs, and 3/4 of U.S. banks with $500,000 or more actually hold life insurance as a general asset as well. The most cited reason by bankers for purchasing life insurance is it provides competitive returns with superior credit quality. And BOLI is an attractive tier 1 asset. So a lot of companies will invest in it for the long-term stability. And the big reason is because life insurance companies don't actually leverage nearly as much as banks do. So cash value is a high quality, low risk asset. And when it comes to why banks are making these decisions about employing these strategies, they understand that they want to have, a better rate of return on their dollars, but also have something that's going to be low risk as well too, to fund different things, again, like healthcare and employee benefits. And this isn't, the first time in strategies like this have been employed. 75% of all Fortune 1000 companies have a corporate-owned life insurance program. In 1929, J.C. Penney used his life insurance policies to meet payroll and day-to-day expenses. In 1939, Foster Farms, borrowed against their policy to invest in an 80-acre chicken farm. And Disneyland was unable to secure a bank loan, so Walt Disney borrowed from his cash value in order to help fund the creation of a new theme park, Disneyland. And then in 1961, Ray Kroc used his cash value from his two policies to cover salaries of key employees and pay for marketing campaigns. So a lot of people have actually utilized strategies like this in the past, and a few companies that own life insurance today are, Citibank, Bank of America, Morgan Chase, Wells Fargo, Procter and Gamble, and Dow Chemical. So when it comes to institutional players, a lot of people are utilizing strategies like this. So I want to go through a little case study and give you guys an example of, what a policy would look like. One thing that I do want to premise here is that it does depend on, age and health. So everyone's a little bit different. If this is something that you looked into in the future, your policy may not necessarily look like this. So I want to just do this for educational purposes here. So say, for example, let's see, am I able to draw on this here? May not be able to. Okay, no worries. But say, for example, you have a policy. So this person, I use myself as an example, I'm not, utilizing it for the overall life insurance benefit. So you're going to see 7 different columns here. You're going to see your death benefit because this is life insurance. That portion will be paid out tax-free if we were to pass away. You're going to see an annual dividend on that policy, your overall net cash flow coming into the policy, your increase in accumulated value, that's what you actually have to access, your net cash flow, that's everything you've paid into your policy, and then your accumulated value, which is, again, what you have to access, and your guaranteed accumulated value. The differences between your guaranteed accumulated value and your accumulated value is that if the company were to stop paying dividends, that's how much you'd be guaranteed. Now, that's why it's important to be with a company that has paid dividends for the last, 80, 90, 100 years, because a lot of these companies have consistently paid dividends. And again, these companies are AAA rated, so you can, rest assured that they'll continue to pay. So with a policy like this, again, it's overfunded. So you have a lot of money going towards that cash value. And in the first 9 years, you put around $431,000 into the policy. Now, at that point, it's overfunded. If you funded it anymore, it would actually become a MEC. So we try to fund these policies so they don't become a MEC. That means that they're going to be taxed when you withdraw them. The IRS has stipulations around that. But with this policy, in the 9th year, you're getting a $14,000 dividend. On the 10th year, you're getting $18,000 dividend, and it just continues to grow then after that. And you can access the accumulated value through distributions, through policy loans, or by using it as collateral to get a bank loan as well too. So if you're ever looking at something like this, it's very important that whoever you're working with, you can see the entire policy. So oftentimes, and I've seen this before, someone may show you like a glimpse of the policy for 10 or 20 years, but they're not actually showing it, long term. So that could mean that that policy may lapse down the road. So it's really important that you're actually looking at the entire, policy you're potentially wanting to get, to make sure there are no lapses happening later down the road that could cause tax implications or anything along those lines as well too. So, let's do a comparison. If you had that 431,000, your average savings account, and I know some of you may get a better rate than the national average, but the national average is only, 0.06%, not too good. Might be able to buy a Kit Kat bar after, 10 years. But after 9 years, with that interest rate, you're going to have around 433,000 in that account. Really not the greatest, paying for your buck. But when we, go back here again and look at, the value after 9 years, you're going to have around 481,000, in a policy like this. So it is, again, for someone that can think very long term, because initially you're not going to have, full access to all the money that you've put in. But it does continue to grow and perpetuate, after it reaches that 8th, 9th, 10th year. So definitely important for someone that has financial conviction, again, that can see long term. So another piece when it comes to infant banking is that you also have access to loans that you can get using insurance as a collateral. So Bancorp is one of the banks that will allow you to take out I-blocks, which is an insurance-backed line of credit. You can think of it as being similar to a HELOC. A HELOC is going to be a home equity line of credit. So with these I-blocks, what they're currently offering is saying that if you have 65,000 up to $250,000, they will give you a loan that's going to be 0.5% less than the Wall Street Journal prime rate. Right now, the Wall Street Journal prime rate is 4%. So that means you can have access to funds at about 3.5. If you're taking out a loan that's $250,000 to $1 million, you're going to get 1% less than the Wall Street Journal prime rate. So again, that's the Wall Street Journal prime rate is 4%, which is where it's at currently, and you have access to funds at 4%. So looking at what that actually looks like, in real time, I did a case study here. So let's say we have Amanda, who's a, really savvy real estate investor. She's recently found a new deal. She also has an overfunded life insurance policy, and through her business. So after talking with her advisor, he suggests that she take on an I-block since the interest on that loan is tax deductible, and she plans to pay it off in 2 years. Because any loan that's taken out, for the purpose of your business, that interest is going to be tax deductible. So the loan amount, would be $360,000. We know that the Wall Street Market Journal prime rate is 4%. By utilizing that I-block, she's going to get that loan at 3%. Now, the internal rate of return in her policy is 4%. So what does that really look like? After 2 years, her total finance charge on her loan is around $11,000. And mind you, that $11,000 is going to be tax deductible to her business because that's interest she's paying. The equivalent cash value in her policy with an internal rate of return of 4% has grown from $360,000 to $389,000. So that's a difference of $29,000. So excluding the rate of return on her deal, the net cost of that loan is plus $17,000. So she's actually made money by taking out that loan because her cash value in her policy is still growing while that loan is out. And say she turns around and makes 10% on her deal or 15% on that deal, that's, added on top of what her overall net cost was here. So to someone that is a savvy investor that can look long-term, it can be a great strategy. Again, it's not for everybody, but for someone that can really do the math and, utilize this strategy properly, it can really be a great, tool in a way to increase your leverage and maximize, your rate of returns. So this was it. I want to go through like questions now for our time together. It looks like there's a couple things in the chat.
There's a couple of things here. First of all, thank you to Kofi. That was great. That was great. That Stephanie says, are those actual rates?
Yeah, for that illustration that I
Yes.
posted.
Yes.
Yeah, those are actual rates.
Okay. Okay, Persephone, those are actual rates, Persephone, actual rates. She said this was a bank's out of business.
Good luck with that. They're very major players, but at World War II, they didn't go out of business, and they didn't go out of business during any of the market crashes, but
they'll always be there. Anybody has any questions? I have one question.
Yeah.
You said make sure it's right for you.
Mm-hmm.
Right?
Absolutely.
You didn't go into specifics. What do you mean by making sure it's right for you?
Yeah, so let me talk more about that. So in the same way that, a lot of people think, okay, like everyone should purchase a house, right? Because everyone needs to build equity within a house.
Mm-hmm.
Well, for some people, may have a very fixed income.
Okay.
And by purchasing that house, they're now going to be exposing themselves to a lot of financial liabilities. If the roof goes down, that's, $10,000 right there. An HVAC unit can be $20,000. So they may be able to make those normal mortgage payments, but they may not have the liquidity to prepare themselves in case there's any type of, major disaster goes on with that house.
Right. Okay.
So when it comes to making any type of financial decision, especially a large financial decision, and something that's not going to just affect you, but affect those around you, I always think it's extremely important to really take into consideration what your personal financial situation is, what your goals are, and see if this strategy aligns with what your goals are. Because there's no one shoe fits all. Everyone is a little bit different regarding their risk tolerance, the liquidity, and so on and so forth. So it's very important to know what your goals are and also work with someone that is willing to understand who you are and what's best for you.
Thanks for answering the question, Kofi. Thank you.
Yeah.
Someone else has a question? Kenneth, you got a question?
Well, the thing is, there's no free lunch.
Mm-hmm.
There's no free lunch. It takes a lot of money to fund your account before the cash value is something that you could actually use.
Mm-hmm.
We didn't touch upon that.
Yeah, absolutely. So let me talk about, funding a policy, because I gave an example there that was a pretty, large overall example. So just like and I reference houses because it works very similar to a house. If you're going to purchase a house, you want to make sure that you can afford that overall mortgage. If I'm making $30,000 a year, I'm probably not going to look at, $1 million house. So this can be scaled, to really any level. It can be scaled down, it can be scaled up just based on what their overall needs are. So if you're utilizing something like this, again, it's extremely important you can make the commitment for the next, 6, 7, 10 years. But you should be working with someone that is going to understand what your surplus is, like monthly, what you can actually afford, and making sure that they're going to be recommending something for you that's going to be, in that best interest. But because of how these policies are structured, you can really, do it with, $1,000 going in their month. The example I showed was, close to around $4,000 a month. It really just depends on what your goals are and how much you want to fund it. The alternative is saying, hey, again, if your goal is to just have safe liquidity and you just want something that's going to be there in the next 1 or 2 years, you can utilize a bank account. But when it comes to the amount, again, I think it just depends on each personal person and what is the right amount for them. Did I answer your question?
Yeah, it's just that, in my experience, the policy is going to be about $7,000 a year, $17,000 to $20,000 a year in order to fund it, so that by year 3, you would have a sufficient amount that you could actually take out money and actually do something with it. Like when I look at the privatized banking, I don't know if we can use infinite banking unless you are like affiliated with the Nelson Nash Institute. I don't know. I just don't think so. In the scenarios that I've run, is that it's going to cost about, at least $20,000 a year for the policies that I have in order to be able to use this in year 3 or 4. So that's the commitment, right? So if you don't have the resources whereby you would be able to keep these policies going for, and I think the least funding period was going to be about 7 years when we did ours.
Correct.
If you can't fund it, then it's not going to be a strategy for you, because then, the first year in insurance, typically the commission goes to the agent who sold you the policy. And then after that is when it starts to fund, but it takes about 3 to 4 years before it's something that you could actually use. So there's no free lunch in America, right? There's no free lunch in the world, to be perfectly honest with you. So that's the thing that whenever I talk to people about this is the thing that they have to consider, is whether or not if they're going to be able to keep it up for at least 7 years so that the policy doesn't lapse, et cetera.
100%. And yeah, that's one of the big points I want to stress there, as I did in that presentation, is, it's not for someone that doesn't have that long-term financial conviction to actually follow through. Like if you purchase anything and you don't plan for actually paying for it that entire time, it's not going to be a great financial decision. So when it comes to funding, like it sounds like in your case, based off the goals that you had for how much capital you needed, that may have been the number that would have been right for you, but everyone's a little bit different.
Yeah, no, and when it comes to insurance, is based upon age, as you mentioned correctly. You have to have an examination where they're going to check you for every little thing. And the great thing about when it comes to insurance, especially whole life insurance, is that it's, it's a 100-year policy, 110-year, 120-year policy, right? Basically, insurance is easy once the actual tables are available, right? The younger you are, the cheaper your insurance is going to be. This is why I tell people, don't buy a 529 plan, don't buy a kid a gift, buy them an insurance policy and fund it for the next 5 years. And that kid would have that insurance policy for the rest of their lives. And I think there are advantages to using a privatized bank versus going with a 529 plan. And help me with this, Kofi. With a 529 plan, if the kid doesn't use the money for college, then that translates into an IRA and they can't get the money to 59 and a half.
So that's a great question. So if someone has a 529 and they don't utilize it, they can transfer that 529 to another family member. They can utilize the money, but the funds that have been appreciated, say they put $1,000 in and it grew $1,000, that is going to be subject to a 10% tax penalty. So those are generally like your options there. So like if you're not utilizing it for education expenses, you can transfer it to someone else, or you can utilize it for other things. You just are going to receive a tax penalty if it's utilized for non-education expenses. And then if you do utilize it after 59.5, then all the gains are just going to be taxed at your normal income rate, as opposed to if you had used it for education expenses, everything is just going to be, tax-free that's coming out there.
Are there any constraints on who you can transfer it to? Well, the whole thing is when parents set up a 529 plan, expecting to use it for their kids. The reason why I like the insurance policy is because I have access to the cash value, whether or not if the kid goes to college or not. Plus, then the kid has the policy, until their death, right? And it's funded. And, I guess if you have the paid up additions and things of that sort, when I look at it and I compare apples to apples, I think an insurance policy is a far better vehicle than a 529 plan.
Yeah, absolutely. And not only that, so if they are taking loans out from that policy, and any of that cash value that's in that policy is also not going to affect their financial aid.
Yeah, that's what I love about it the most, is that you don't have to record it on your FAFSA,
Yeah.
the insurance policy. So that's another benefit versus going to the 529 plan.
Mhm. Yeah, and I generally recommend, because with how school is starting to progress, that, a lot of people just aren't, they're finding careers without going to college. Not to necessarily just shove everything into a 529, because it limits options if your kids don't go to college. And with how the rate of school is rising compared to, for example, incomes, like the rate at school is rising just isn't sustainable. Like
Yeah.
it can't continue to rise at the rate it is. So we do foresee, some type of intervention, whether that be reducing school costs or having more subsidization of the cost of school in the future. So you just say not to overfund those 529 accounts for 10, 20, 30 years down the road.
You just said something just now about loans at the end of the year. How many loans can somebody take out on insurance in 1 year?
Yeah, so they can take out as many loans as possible. It actually depends on the amount of the loan. So you can access about 92% of the cash value. And the reason why that number is, generally around like 92% is because it prevents the policy from lapsing. So if you were to be overloaned, you could have that policy lapse, which could create a huge tax burden. Like if you've contributed to that policy for 20, 30 years, and your basis is 300,000, but your money has grown to say to 5 or 6, then you're now responsible for a $200,000 to $300,000 influx of income. So it does have caps on that loan to prevent that policy from lapsing.
Anyone has a question? Okay, well, I have another one.
I do too. Your call though.
Well, go ahead, Lee, because you go ahead, Lee.
One of the things that I don't understand so much, Kofi, is we went with Penn Mutual, and I believe Penn Mutual is a direct recognition company. It wasn't explained to me fully about the difference between direct recognition and non-direct recognition when it comes to the policy, but my examination of it tells me that it's really a wash, right? Because the direct recognition company is going to give a higher dividend, whereas a non-direct recognition company is going to give a lower dividend. So maybe for the audience, you could explain what direct recognition is and the differences between the two.
Yeah, absolutely. So two main types, as you said, there's direct recognition and non-direct recognition. This really plays into part when you're actually taking out loans from your policy. So when you have a direct recognition company and you take out a loan from your policy, the loan that you're taking out, the interest rate that's going to be applied to that loan is going to be the same rate that's applied to everyone else that's in that company. So if you have a lot of people that are, taking out loans in the policy, you have a lot of people that are taking out loans at one time period with that company, that's money that's leaving that general account in that company. So the interest rate, because it's direct recognition, can be affected if you have a lot of people that are over leveraging policies in that company. So this would really come into play like in a rare situation if a lot of people took out policies all at once. But outside of that, it's not very common. In a non-direct recognition company, when you take out a loan from that company, they're actually going to credit you a slightly higher rate and put your loan into a different separate account. So when you take out a loan from that non-direct company, your policy loan isn't going to impact other policyholders. So for many companies, they feel that that non-direct way, if that rare situation was to happen, is actually in the benefit of the policyholder, because other policyholders that are taking out loans, that isn't going to affect like your internal rate of return on your policy. So in the grand scheme of things, like it's not going to be a huge difference unless there's that rare situation. But with a non-direct company, they're going to credit you a slightly higher rate. But with a direct company, they're going to credit you that same rate as with any other company on loans.
I thought that it was with direct recognition, they recognize my loan, which lowers my cash value, right? And then they're going to apply the dividend rate against the lower cash value. Whereas with a non-direct recognition, my cash value isn't impacted by the loan, but of course the dividend rate for the non-direct recognition company is lower. So, you know, it's like a wash in my mind. I guess I would have to get into Excel and run through a bunch of different scenarios in order to be able to make sense of it all. But, you know, I'm not going to spend too much time on it. I just went with Penn Mutual. You know, I'm thinking about getting another couple of insurance policies just the same. And I think this time I'm going to probably use a company, somebody that works with Lafayette, because I know Lafayette Life is a non-direct recognition.
Yeah, and one thing I would recommend there is just going with a major player. So there are like, and I'm not gonna say I'm experienced with every single company that's out there. But there's generally like 5 companies that I do recommend when it comes to these different banking policies. And for me, it's more contingent upon like the dividend rate of that company, and then also the mutuality of them. So I usually say like New York Life, Northwestern Mutual, Guardian, Penn Mutual, and Prudential. They're usually companies that I recommend.
Aren't those shareholder companies?
No, Northwestern Mutual, Mass Mutual, Prudential.
Just
I believe Prudential actually did turn to a shareholder as of recently, but they still have a very high dividend rate. Guardian, and then Penn Mutual as well too.
Okay.
Lafayette. I know I have heard a couple of different people utilizing Lafayette. I haven't done as much research into them, so I couldn't actually say for. I can say with certainty what their dividends are, and like what their overall financial strength is. But I usually stick to those companies there.
Is that the Comdex rating, something rating that you're supposed to look for to understand the strength of the insurance company?
So you'll look at, you can look at the financial strength. So it's the ratings based on the S&P, AM Best, and Moody's and Fitch. Those are going to be the rating agencies that'll go through and rate that company based on financial strength.
Yeah, but I don't trust those companies because those are the same companies that rated all the default swaps and all of those. So it's
true.
You know, with having insight into the industry, do you trust like Moody's and Fitch and Standard & Poor's anymore, or do you take it with a grain of salt?
Well, I do take it with a grain of salt, just because like then you're absolutely right. They did, rate those, for example, collateralized mortgage obligations very well in 2008, which definitely wasn't the case. But with that, I guess those are the main things I'm looking at for when it comes to insurance companies, for those rating agencies. So I try to also look at just like the overall history of the financial strength, seeing, okay, like, is this company ran well? Like, do they have a low expense ratio? Just as I would evaluating a stock, do they have a low expense ratio? Do they have a lot more assets than liabilities? Like, I'm actually going through and looking at their financial sheets to say, okay, like, do the numbers actually make sense, in addition to these ratings as well?
Yeah, and Penn Mutual, when I looked at them, I think they've been around for 165 years, always paid a dividend. So pretty solid company. I just didn't know, like, if I had to compare one company to another company to another company, is it best to do that off of, when I was doing my research, I remember there was some type of rating. I thought it was Comdex or Com something. That was the rating. Is that the way that you compare one company, one mutual company to another one?
I actually have access just through my company to a software that allows me to see the financial reports of any company. So I actually use that software so I can go through and see, okay, like what is a detailed financial report for each of these companies?
Got it.
So it's just a proprietary piece of software that I'm able to, utilize and access, and more than happy to answer, questions for anyone or just give information if you guys are trying to make a decision.
Yeah, thank you. Thank you. I appreciate your time.
Yeah, absolutely.
Thank you, Lee. Now, my question was, you want to start an insurance for a child.
Mhm.
What is the process for that? What is the process for that? And how does it start it?
Yeah, if you want to start a policy on your child, it's relatively easy if your child has had no medical problems in the past. So, that is a contingent, that is an important factor for any type of insurance. You have to go through underwriting. But if someone is, under 18, and they have no negative medical history, it's pretty straightforward and it's pretty simple. So you would just apply for that insurance policy. Since that person is under 18, the parents or guardian would be the owner on that policy. Your child would be the insured, and then you also would have a payer and an applicant. You generally have 4 parties to an actual policy. So you would establish that policy for most companies if they're under 18. It doesn't require much of a medical check. It just requires, a questionnaire. And then you'd go through that process and, have that policy, then they're established after that.
So now, because we're talking about overfunding and bonding. So now how would that work out with that type of policy?
Yeah, so you can do the same thing with that type of policy. So like, I use pretty large numbers there for my example, but you can overfund a policy with, any amount. It's the big thing that you want to be aware of is that like the IRS, back in the 80s, a lot of people were actually overfunding life insurance policies because back then interest rates were extremely high. And there was also a lot of market volatility. So the appeal of having a policy that could get 8, 9, 10% of a rate, and the ability to just put in a bunch of money into there and then immediately have this tool going for you was very appealing to a lot of wealthy people. So the IRS created this limit called a 7-pay limit, that essentially you have to fund a policy for 7 years. And you can't go over a certain limit of cash value compared to your death benefit in order to make sure this policy does not become a MEC, a modified endowment contract. If it becomes a MEC, then everything you take out is going to be taxed. So you can still overfund that policy. You just have to stay within that limit when you're overfunding that policy. And then it's just going to, it's going to be the same principle as, any other infinite banking policy, just depending on how much you're putting in, that'll be, how much you have to take out and so forth and so on.
Thank you, Kofi. Thank you again.
Yeah.
We're going to end it right here. I'm going to end the recording. I should say that, right? It's too late now. So we're going to end it right here. And once again, Kofi, thank you, Lee. Thank you, Kofi, for coming on tonight, taking the time to come on. I want to thank everybody for coming here onto Financial Independence through Small Multifamily Investing. See you next week, Tuesday, 7 p.m. again. Thank you very much. Have a great evening.